Assalamu alaikum, guys. So recently, Elon Musk was asking Cathie Wood, this was on April 5th of 2021, asking Cathie Wood about her opinion on the high ratio of the S&P market cap to GDP. Now, the ratio of the S&P market cap to GDP, for those who are unfamiliar, is referred to as the Buffett indicator. And it's called the Buffett indicator because Warren Buffett in the early 2000s referred to it as the best indicator of where valuations stand at any given point in time. The Buffett indicator basically measures the value of all public companies, how much they're trading for on public markets, and compares that to GDP, which is basically how much goods and services the economy produces. The higher the Buffett indicator is, the more likely it is that stocks are overvalued. And the lower this indicator is, the lower the probability that stocks are overvalued. Historically, the Buffett indicator has been around this green line right here, which is between 0.75 and 1. Currently, we're at a point, as of April 7th, 2021, we're at a ratio of close to 2. And this is very concerning, considering the fact that right before the dot-com bubble burst, this ratio was close to 1.5. In 2007, when the housing bubble burst, this ratio was just above 1. And now we're talking about a ratio that's close to 2. And this is what Elon Musk was asking Cathie Wood. And it took Cathie Wood about 6 days to reply, but when she did reply, she said the following. And I'm going to give you a summary of exactly what she said. If you'd like to read her response in detail, go to her Twitter page and you can read her response there. But I'll give you my summary basically of what she said. Basically, she said that, yes, it's true that if you look at recent history, the ratio of market cap to GDP is high. This is correct. However, if you go back to the late 1800s and early 1900s, as these new technologies like telephone, electricity, and automobile were emerging, the equity market cap relative to GDP appears to have been 2 to 3 times higher than it is today. And she uses the verbiage appears to have been because really data at that time, I'm not really sure how reliable it was, or even if they were measuring things like GDP and market cap for all public companies. So I'm not really sure how she got to this number, but that's the claim that she's making. And she actually says we need to verify this difficult to get data, but if true, she has a hypothesis. And her hypothesis is as follows. The market cap is high, that's correct, but that's for a very good reason. And that is because interest rates are very low. So if interest rates are close to 0, then people are not going to buy bonds, they're going to buy equity. And that's going to push the valuation of equity higher. Additionally, as it relates to the second part of this ratio, which is GDP, the denominator, this number is low because of the technological advancements that are happening at a rapid pace. And this causes GDP to appear lower because technology brings down the costs of making goods. So for example, 3D printing has made the production of previously very expensive, highly complex parts a lot cheaper. So that makes manufacturing a lot of different products cheaper. Additionally, these new technologies put a lot of pressure on the old guard to lower their prices in order to remain competitive. An example of this would be internal combustion engine car manufacturers. So with the addition of electric cars, these manufacturers now have much less wiggle room in price because if they are to raise their prices, electric cars are going to become that much more attractive. And people are already flocking to electric cars because they know that basically the writing is on the wall. This is the way of the future. Why not buy a car that's going to have a decent resale value as opposed to a internal combustion engine car, and who knows what the resale value of that is in 5 or 10 years. So there's a lot of pressure on these traditional auto manufacturers to keep prices down. So this technology that is emerging in a number of different fields is causing prices to go down, which is causing GDP to appear lower. And so you have this confluence of market cap being high because interest rates are low, and GDP being low because of the technological advancements that are happening, causing this Buffett indicator to be unusually high. This is the hypothesis that Cathie Wood has posited to us. I do think that the points that Cathie Wood has brought up are rational. They make a lot of sense. And I do think that they're contributing to the Buffett indicator being as high as it is today. Now, to what extent these factors that Cathie Wood brought up are behind this elevated valuation versus just pure irrational exuberance and speculation is anyone's guess. It's hard to tell. But I do definitely think, as I mentioned, that there is a lot of merit in what Cathie Wood has brought up. Additionally, what is clear to me from looking at the Buffett indicator and from the performance of the S&P 500 is that timing the market based on this indicator is probably a fool's errand. So let me give you a real life example of why I think that's a fool's errand. If you look, as I mentioned, in the year 2000, the dot-com bubble, this indicator was close to 1.5. Now, it reached that same level of close to 1.5 in September of 2018, very close to that level, the high before the dot-com bubble burst. So if you were trying to time the market based on this indicator and you sold in September of 2018, you missed out on the tail end of this recent gains and progress of the S&P 500. So if you look at the S&P 500, and you look at where it was in September of 2018, it was around 2,800. Now it's at 4,100. So it's possible if you try to time the market that you deprive your investments from years of growth. And this is why I think that it's probably a fool's errand to try and time the market based on this one indicator. The next point I'm going to make is that I think the Buffett indicator is a much more pressing concern if you are investing in the broad market. Let's say you're investing in a market tracking ETF. Then the Buffett indicator is perhaps a bigger concern for you. However, if you're being selective about the stocks that you're investing in, and you're investing in, let's say, stocks that have very strong balance sheets, that have moats around their businesses, that are operating in high growth industries, then I think the broad market valuations are less of a concern for you because you're not investing in the broad market. You're being very selective about the investments that you're making. And that's the strategy that I am following. So if you look at the increase in the money supply since January of 2020, it's basically gone up vertically. It's never done this in recent history. And I think it's very logical to expect that if you have this rather large increase in the supply of a particular currency over a short period of time, that the value of each individual unit of that currency is going to fall. So it's very hard to rely on cash as a store of value. And when equity prices are at such an elevated level, it becomes hard to rely on them as a store of value. So where are people going to put their money? I think this environment makes Bitcoin an increasingly attractive asset that more and more people are going to use to store their purchasing power. And this is what causes me to be so very bullish on the price of Bitcoin for the rest of 2021.